So what if one of the world's most critical oil choke points just stays clogged up, like until late summer, or maybe even longer? Well, that's exactly the bet that traders are making right now, and let me tell you, it could send some serious shockwaves through the US economy. Let's really get into what's happening.
The burning question on everyone's mind is this: when would the Strait of Hormuz actually get back to normal? We're going to dig into why traders on the prediction platform Kalshi are getting more and more pessimistic, and, more importantly, what that signals for oil prices, for inflation, and, yeah, for all of our wallets.
All right, first things first, let's look at what the markets are actually predicting. This is where you can see the collective wisdom, or maybe the collective anxiety, of traders playing out in real time.
And here it is, the big headline number. Traders are now betting there's less than a 50% chance that shipping traffic in the Strait of Hormuz gets back to normal by June. That's a huge red flag. It's basically the market shouting that a quick fix is looking less and less likely.
Now, check out how this timeline is getting pushed further and further out. The odds for a June reopening are pretty low. And yeah, they climb a bit for July and August, but look closely, they barely cross 60%. So what does this tell us? The market is betting on delays, and even a late summer reopening is far from a sure thing. There's just a ton of uncertainty baked into these numbers.
So what do we even mean when we say normal? Well, Kalshi has a really specific target for this. They define it as 60 ships passing through the strait every day, based on a 7-day average. That number, 60, is the key benchmark we got to keep in our heads.
And this right here is what really puts the whole disruption into perspective. Before all this conflict, you'd see over 100 ships passing through on a daily basis. So that normal target of 60 ships, that's already a massive, massive drop. We're not even talking about a full recovery here, not even close.
Okay, so a shipping lane thousands of miles away. Why should we care about it here in the US? Well, because the economic impact hits us right where it hurts. It's very, very direct.
I mean, the scale of this is just staggering. The Strait of Hormuz handles about 20% of the entire world's oil supply. Think about that. When a choke point that affects 1/5 of the globe's oil gets squeezed, you better believe the ripple effects are felt absolutely everywhere.
And we are already seeing that impact. Brent crude, that's the main international price benchmark for oil, has climbed back up over $100 a barrel. This isn't some far-off risk. It's a price hike that is happening right now because of this slowdown. So here's how it all trickles down to you and me. Higher oil prices, that means higher prices at the gas pump, obviously. It also means higher shipping costs for pretty much everything you buy. And all of that just keeps piling pressure on inflation. It's a straight line from that strait right to your wallet. So, if the economic stakes are this high, what's actually causing the gridlock? Why isn't this getting fixed? It all comes down to a really, really complex geopolitical situation.
And this really gets to the core of the tension. It's kind of like a good news, bad news situation. On one hand, the good news, the ceasefire between the US and Iran has been extended. But the bad news is that ceasefire has not led to an actual deal to reopen this critical shipping lane. And the reason why is because tensions are still just incredibly high. You've got Iran seizing commercial ships in the region, you have the US continuing to maintain a strong naval presence, and the political talk from both sides just keeps getting louder and more intense. It's basically a standoff with no easy way out for anybody. And Iran's leadership has made their position crystal clear. They've flat out said that the strait won't fully reopen as long as the US naval presence, what they call a blockade, is still there. So what should be a logistics problem has become a high-stakes political standoff.
Okay, so given that political stalemate, let's take a look at how the broader markets are pricing in the risk of this thing dragging on for a lot longer.
Analysis from UBS paints a pretty clear picture here. A long disruption would keep energy prices elevated, no surprise there. That in turn would probably slow down economic growth and just put consumer wallets in a vice grip, squeezing families who are already dealing with inflation.
But, the overall economic picture is complicated. While this whole energy situation is putting on the pressure, other fears actually seem to be cooling off. In fact, Kalshi traders have lowered the odds of a US recession in 2026 to just 26%. So the outlook is kind of mixed. A headache from energy costs for sure, but not necessarily a full-blown economic migraine. All right, let's pull all of this together. After looking at the data, the politics, and the potential impact, what's the one big thing we need to remember from all of this?
The bottom line is really simple. The Strait of Hormuz is not just a line on a map. It is a massive lever on the global economy. And right now, the traders who are betting their own money are signaling one thing loud and clear. Do not expect things to get back to normal anytime soon.
And that leaves us with a really crucial question. Are the markets getting this right? Or are they maybe underestimating the risk of an even longer conflict? Or, hey, maybe they're overreacting? Let me know what you think down in the comments. We're going to be keeping a close eye on this, so make sure you subscribe for any future updates.